Hello and welcome to the Mutual Fund Show. I'm Neeraj Shah, and today on the show we will discuss about the price and value conundrum. I know a lot of people talk about price and value with regards to investing in stocks, but the same application or the same is applicable in mutual fund investing as well. Should you look at the P multiple of the indices while you're taking your decision to invest in mutual funds? That's the question that we're going to ask our expert who will be joining us in moments from now. I just wanted to start off with a small chart that we've plotted on the Bloomberg terminal and just get it on the screen for you. And we marked two specific points out there, the two circles that you see. So the two lines, one is a green line, a padded green line, and one is a turquoise blue line. The turquoise blue line is the PE multiple chart. Now, if you look at the first circle, the first marking, which is right in the middle of the screen, you will see that that is the point of time when in 2015 the P multiples were fairly elevated, not extremely elevated, but fairly elevated. If you look at those P multiples and decided not to invest in equity markets, then you would have missed out on that entire green run, entire run that the green worm has shown from mid-2015 until the current levels. Similarly, at the end of the chart, you're seeing the second marking wherein again, for a temporary period, the price-earning multiple was fairly elevated. It came off sharply, but that notwithstanding, if you had chosen to look at the markets at those elevated PE levels and not invested in the markets, you would have missed this entire 15-20% run of 2017. Now, does that mean that if you have missed out, you shouldn't invest? Even that's a wrong notion, probably. But let's talk about why you probably should not look at an absolute P of the markets if you're indeed investing for a really long term. If you have a 6-month or a 1-year horizon, then maybe, just maybe, the call could be different. But let's pose that question to Sunil Subramanium, CEO of Sundaram Mutual Fund, joins us on the show yet again. Great having you, Mr. Subramaniam. Thanks so much for taking the time out.
Good afternoon.
Now, what is your belief? Are you a staunch believer that it might be wrong to look at a 22, 23, 24 PE and make an investment call in the mutual funds? And why so? Why is it wrong? Because at a 24, 25 PE, there is a high probability that equity markets could correct and I might get a lower NAV for my mutual fund investment.
Okay. So the key point here, I would like to start a little bit earlier than getting into stock markets on what is price and value, the price-value conundrum. So stocks are a commodity like any other commodity in the market. And every commodity, the value addition that finally results in the commodity is the value of the commodity. So you take, for example, an automobile car. There's a certain amount of steel which goes into the car, which has a certain value at the entry point. When the car is finally sold, that same steel is valued probably at double or triple because there's a value addition, the cost that goes into making that steel into a product useful to the consumer. So value is the solution to some need of every commodity in the marketplace. If it's potatoes, it's satisfying your hunger. If it's a car, it's solving a transportation need. If it is stocks, it's solving a wealth creation need. So keeping that perspective in mind, the price of any product, it starts off with the value as a base but the final price has nothing to do with the value because it is decided by beauty lies in the eye of the beholder. The price is paid for the value he's getting from that thing, which could be independent of what value has gone into creating that value. So what do I mean by this? First, prices are driven by demand and supply. So in the case of stocks, coming to that, there is generally no supply issue because there's a set of free floating stock available. Sometimes there's a bunch of IPOs coming in which increases the volume, but otherwise supply is not an issue. But demand for stocks comes from per capita incomes of people, because whether it's a mutual fund, insurance, or a bank investing in the market, ultimately it's individuals' money. So per capita income availability for the stock market, one. Second, what is the price or the return expectation of alternatives? Just like if potatoes go to 1,000 rupees a kilo, you will probably switch to yam or some other carbohydrate product. Such as if a car goes too high, you will probably think of the metro as an alternative to getting, or a carpool to getting thing. You look at the alternatives. So the alternative space which compete for stocks are other wealth creation products, which are either physical products like land and gold, or other financial assets like bank deposits, private deposits, insurance policy and the like. So the price is actually decided by these two factors. So when you are then coming to a mutual fund and you are investing, the disclosed PEs in the market are generally a trailing PE, which is today's price per last year's earnings, or a forward PE, which is the current year, or at the best the next year. So today we have an 18-month FY19 PE available, but your mutual fund investments are typically for 3 to 5 years. So by looking at the earnings potential for the next 18 months, you are taking a 3 to 5 year call. Prima facie, that's on a wrong wicket. Second point, you're looking at the PU of a broad index, either it's a Sensex or a mid-cap index or a small-cap index. But every fund manager has the ability to A, not buy certain stocks within the index, stock up on more of certain stocks within the index, and 3, buy outside the index. So as you know, SEBI's latest rule says top 100 stocks can be a large cap funds portfolio. But Sensex has 30 stocks, Nifty has 50. That means a fund manager has at least another 50 to 75 stocks outside of the index where he can actually go and buy stocks. By looking at the PE of only those stocks within the index, you're again not going to get a judgment call. The third and most important thing, every fund manager in a mutual fund knows that customers are coming with a 3 to 5 year outlook. So how does a fund manager decide whether this stock is overvalued or unvalued or worth buying it for me? What a fund manager does is, while the PE ratio in the market of a forward 18 or forward 19 is available based on today's price, he does a future profit projection for the 3 or 5 year time frame that he has for that stock. Point number one. So he then discounts that at the company's cost of capital to today's value, looks at it and compares the price, and if it is, the value is higher than the price, he buys it. So the fund manager whom you are trusting is actually doing the proper calculation within the time frame which an investor is looking, and then arriving at the true value of that. So I think in these points it clearly tells you, and a shocker to people, that if they actually start getting mutual fund portfolios and try to arrive at the PE ratios of the stocks within a particular fund house's portfolio, that PE ratio could be far higher than the market, because his calculation says this company next year its earnings might be dropping because he's in awe. And the final point I'd like to stress is PE ratios, the E is EPS. But no fund managers uses E. All fund managers use what is called cash flows, for the simple reason that depreciation is an expense, right? It's a non-cash expense. But the reported earnings always subtracts depreciation, and hence a company which just set up a new plant and machinery, his earnings for the current year and probably for the next year will get depressed till that plant comes into circulation. But by taking cash flows for projection, the fund manager is able to look at the future cash generating potential of the company's assets and take the appropriate call, and not go by a artificially depressed earnings, because market doesn't calculate PC ratios but calculate P. So there are multiple reasons, like I said, where the call for looking at a P which is coming to you from the media, from the papers, and saying, oh, large caps are quoting at this, mid caps are this, so I should do my allocation, is basically flawed. Basically because once you trust a fund manager, he is doing the appropriate calculation. So I think that's the point I wanted to make on a price versus value conundrum.
Fair call. I'll like to quiz Mr. Subramaniam on a few points as well. Just keep in mind, if you have some questions for this topic, for Mr. Subramaniam or our financial expert who will be joining us in moments from now, we'll have a mutual fund advisor come in and talk about what schemes you could look at if you do not want to look at the PE multiples but want to look at the long term. Then we'll have some recommendations coming in as well. But do send in your questions if you have them on our Facebook page, and we'll try and get some of those answered. The question though, Mr. Subramaniam, is not just about whether an investor, because we're using the term PE multiples, and which is why I'm bringing this point up. For an equity fund, there is competition within the mutual fund industry of non-equity linked funds as well, right?
Correct.
And that's where I'm asking a question from a retail viewer's perspective, because a viewer would believe that when we are talking about stock markets and mutual funds, we are talking about essentially about equity linked funds. We did a show 3 weeks ago with, I think, Axis AMC, and their study suggested that over a 10-year period, specific price points from specific points, it's not necessary that equity funds have outperformed debt funds in a meaningful way. My question to you is that these elevated PE multiples, while it might be wrong to look at PE multiples to base your decision on a mutual fund investment, would it make sense to look at alternatives within the mutual fund industry itself? Look at debt funds, look at hybrid funds, look at balanced funds as opposed to pure play equity funds.
Yeah, see, I don't disagree with the point of view that at some points in time, debt funds could in short periods give better returns than equity funds, right? But I'm saying that the P ratio is not the way to judge that, for the simple reason that when you look at the returns from alternative asset classes, right? And here you're talking about debt as an alternative asset class, right? Typically, if you look, there's another way of interpreting the P ratio, right? That is, if you take a P of 17, let's for example, you take 100 divided by 17, it gives you the return to be expected from that asset class if earnings didn't grow at all. So typically a bank deposit would be at 17 PE, because at 6%, 100 by 6 is 16 point, roughly 17. So in a bank deposit's P ratio is 17. But that's because you know that the earnings are never going to grow above 6. So if you take the equity market at 17, it means that if the companies in the index earnings never grew at all, you would get a 6% return. Now what's the bet? That even if there is of 2% or a 5% growth, you would get a better return than a fixed interest instrument. So the point I'm trying to say is purely on PE ratio, as long as the multiples show that even if the earnings don't grow, you're still going to get equal to a fixed deposit, it shouldn't worry you. Whereas fixed income instruments, which debt mutual funds invest in, they do tend to give higher returns because of the play on duration, which has totally nothing to do, which is a call based on where you see interest rates moving, which is, P is a static number. But duration is a dynamic, forward-looking thought process. So I think the decision making on how much do I put in fixed income should be based on your advisor's advice on where is the interest rate outlook moving, and can I make capital gains. But on the pure returns of fixed income, the coupon interest or the whatever, I think the argument is fairly clear that as long as the PE ratio, now if PE is moved to 25, then 100 by 25 is 4%, then you say, okay, am I getting 6% from my fixed deposit versus 4%? That's a different kind of a conversation.
Okay, fair call. But we'll take this conversation forward. I already have a few questions from Advait Vaidya and a few others. But I first need to get in Jayesh Khilnani. And Advait, hang on. We'll talk about your query that you posted on a Facebook page in moments from now. But Jayesh has analyzed the earnings, how the earnings trajectory has been and what's expected going ahead from a pure index perspective. Jayesh, tell us what have you analyzed?
So Neeraj, in line with today's theme, when most of them are saying that P is not to be looked at, what we did instead was look at how the earnings growth has been, or the EPS for Nifty has performed over the last 5 years, and what is expected as per the analyst tracked by Bloomberg. So this chart shows you in FY13, Nifty aggregate EPS grew by just 2%. Going forward, it also did about 13%. FY15 and 16 was not good, where the EPS actually saw a decline of 4% and 3% respectively. What is interesting is the turnaround that happened in FY17, where the EPS grew by as much as 11%. With this FY17 EPS, currently we're trading anywhere between 22 to 23 times earnings, that is for FY17. Now the analysts tracked by Bloomberg and the expectation that they have given us for FY18, 19 onwards as well, they show that Nifty EPS is projected to grow as much as 16% for FY18, and for FY19 also a similar number can be projected. So with this, what will happen is the current PE that is trading in anywhere from 22 to 23 will come down to somewhere between 17 to 14 times. So that's the reason we are looking at P ratio from a 2 to 3 year perspective, which is likely to reduce going ahead.
Okay, interesting, and that's I think the point that Mr. Subramanium is trying to make, that if you look at just the current year PE, it might actually give you a wrong picture as well. And the fund manager is actually investing in stocks, looking at the earnings that will come out over the next 3 years. And if you indeed have that view of 3 years, 4 years, and can analyze all of those, then maybe, just maybe, you might not find the P ratio too expensive as well. But for a retail investor, it might be best to ignore the clamor about the PE when you're talking about funds, investing in funds. Now, my question to you, Mr. Subramaniam, is, and there are a few queries that have come in, so I'll actually like to get into a couple of those queries as well.
Sure.
And it's pertinent, because I think Advait Vaidya is the viewer who's sending a question about, is it the right time to invest in pharma funds? And I think the question emanates from probably the perspective that the P multiples on pharma companies might be looking cheap. Now, I'm not asking you to comment on a pharma fund, but the whole notion that should you invest in a thematic fund or a sectoral fund if there is an availability like that, because the P multiple is low. The same way that you don't invest in mutual funds when the P multiples are high, should you invest in a thematic fund if the P multiple is low?
Well, okay, so prima facie, the one space where PE multiples do have some relevance even to mutual funds are sectoral funds,
Okay.
which are in the thematic play. Why do I say that? Because PE ratios, though they are only 1 year forward, disclosure, it indicates the sentimental approach that the market has to the earnings from that particular segment. Now, when should you invest this? When you have a contrarian view to the earnings reflected by the market on that particular thing, right? The reason he's asking the question is, today pharma stocks are beaten down,
Yes.
so the market is expecting. Now, the point here is that the answer to this is very, very simple, right? He has to wait for the time when the inflection happens. Okay, and here I'd like to go back to some brain neuro thinking. The human brain is wired to linear thinking. Okay, and what I mean by this is, let's say a company's earnings grew 12% 2 years ago, and it was 10 last year. The human brain automatically projects 8 for next year.
Sure.
This is a part of that. If you look at consensus estimates, analyst estimates, you will always find, especially in cyclical sectors, right? You have this. And then when the inflection happens, right, that's when what happens, when you catch it at inflection points, is when you can then see that as the market turns to an 8 versus 10, then the projection comes to 12. And this is one of the brilliant ways that the market delivers returns to you. It's called PE re-rating, right? That's the answer. So in thematic and in sectoral cyclical spaces, right, there is definitely an awareness of the cyclicality of the sector, and what is likely to underlying change in the fundamentals of that sector should be a useful trigger is to look at the PE ratios, how they are moving. Because the change of the PE ratio from a continuously dropping to a rise is the inflection point, which gives you a clue that it's fairly a good time to do that. Now, I don't know about in the case of pharma, the case for that is not yet very clear.
Right.
The case for, I would take another sectors just to explain to Advait.
And just a question, which is why are you bringing in this point that asset allocation should be based on under and over valuations?
Brilliant. Yes, absolutely. Asset allocation, you should be under valuation and with a knowledge of the cyclicality of the Indian economy, on what position we are. For example, in this particular context, if you take a look at it, right? See, what is the issue of cyclicality? The thing is that in any economy, there are defensives and cyclicals. So for defensives, the PE ratios are a more stable, closer link. But in cyclicals, this issue arises that there is a continuously falling PE and then the inflection occurs. Why does this happen? Because typically cyclical companies, right? What happens when an economy is going in a bad cycle is because the economy is down, their sales come down, their fixed assets are fixed, so their operating leverage brings down their profits. And the same thing happens that the inflation shoots up in such a time, interest rates come down, and their fixed costs, the interest. Whereas if you take a positive, when you go from a vicious cycle to a virtuous cycle, economic recovery means that sales goes higher because demand is greater than supply, margins grow higher, so your operating leverage contributes to profits. At the same time, in such a time, inflation comes down, interest rates come down, their interest costs come down. So cyclical companies benefit from operating leverage plus financial leverage, and hence future EPSs rise compared to the past. And the market realizes this only when that gets reported and then shoots up. So if you look at cyclicality today of the Indian economy, we are exactly in the middle of proceeding through a good cycle. Why do I say that? A good cycle, like I said, right? Today, what happened? When Mr. Modi came to power, oil prices dropped. So due to no fault of his or success of his, prices came down, interest rates came down, demand started picking up, but still private sector capacity utilization was still low.
Sure.
But governments used that oil 65,000 crores to kickstart the investment cycle. So you have an investment cycle which the government is now kickstarted and driving, but the private sector is just to participate. So if you look at it, we are bang in the middle of going from a bad cycle to a good cycle. So as these cyclicalities, all these companies which were hitherto in an excess capacity situation, I've got a low reported earnings and market's expectation is also low. So a classic example here is in the infrastructure, and I'll give an example which would explain to the viewers this in a very simple way. Right?
Sure.
You take the NSE Infra Index. It's a beautiful example of cyclicality. In 2007-8, when this infra cycle was boom, and you know in infra you can't use PE ratio because earnings can be negative in the bottom line. So let's use price to book. The infra price to book at a peak was 2.9x. Today it is 1.8x. Okay? And 1 year back it was 1.4x. So you are at an inflection and it's rising. And how does this translate? Let's compare the NSE infra price to book to the Nifty price to book.
Sure.
At the peak, the NSE infra price to book was quoting at a 12% premium to the Nifty price to book.
Sure.
Today it is at a 30% discount. right? So what I'm saying is, if the Nifty goes up 10%, this is going to move up 4.42, right? And it's already showing. If you see the average infra funds in the market, in the last 1 year, when we talked about 1.4 to 1.8 price to book,
sure,
the discount has gone from minus 35 to minus 30. That is, there's a 5% improvement in the discount,
sure,
and the inflection has happened. You know what infra funds have returned? 45% in 1 year. So this is precisely the point. So when he asked the question about pharma, I would encourage him to look at infra. If he really wants to take a cyclical bet based on low PEs, infra is the place to look at.
Okay, one final 1 minute answer, Mr. Subramaniam,
sure.
And then we'll get in Gajendra Kothari as well to talk about some specific scheme recommendations, because I can't ask those to Mr. Subramaniam. But very quickly, 1 minute, would it be a prudent idea to invest into balanced funds currently, or would you stick to pure play equity funds? 1 minute.
It depends on the investor's risk appetite. A new investor, first time to mutual funds, balanced are probably a good entry point. To an experienced investor, India is the middle of a bad to good cycle, right? This is the time to take risk and earn the reward. By putting in balance, you're actually reducing the risk. So for an experienced mutual fund investor who's already been in the market for 5 to 10 years, I don't think he needs to put money into balanced funds. For a new first-time investor, yes, because you got to, like going through a baby pool before you can do the bigger pool.
Okay, so if the stomach doesn't flutter, go out for equity funds.
Yes.
If you have those pangs, then maybe start off with the balanced funds and then go on to equity funds.
Yes.
Okay, this is great. Thank you so much for your time, Mr. Subramaniam, and talking to us about the price-value conundrum. But I think the key learning from what Mr. Subramaniam is trying to say, that if you are indeed wanting to create wealth and wanting to invest in mutual funds, don't look at necessarily just the P multiples of the market and the noise surrounding that. That might be a wrong thing to do. Just invest for the long term without looking at what the pure play equity multiples might be showing. Now let's talk about that further. And what is it that the advisor community believes? Gajendra Kothari, CEO of Etica Wealth Management, joins us on the show. Now, Gajendra, good having you. Nice to have you again on the show.
Pleasure's mine, Neeraj.
So, Mr. Subramaniam had to say that don't look at P multiples right now. For somebody who is not a completely new investor, but definitely not somebody who's got 20 years, 25 years of mutual fund experience.
Right.
Would you recommend a mixed approach into investing into mutual funds currently?
So I would say normally for a investor who has a 5, 8, 10 years horizon, P ratios generally doesn't matter. A good 70% equity and 30% debt allocation would take care of your overall long-term returns, right? Only in those 5 or 10% of the circumstances, the P ratios would matter when the markets are all-time, you can see a bubble kind of thing of froth happening, like 2007-8, when we could see everything was there. And one should also look at Neeraj, P ratio is both P and E. One should not look in isolation. Right now, the only thing which is going up is price. Earnings are down, actually. So if earnings catch up, P ratio would normalize. If you take the US markets, both P and E are all-time high. That's why there's a bubble kind of thing. It's a risky scenario. So in India, right now, though we say that P's are at 26, 27 levels, it's not very scary because earnings, just now, when we saw early in the show, that earnings has been quite flattish. In fact, in 14, 15, 16, it was negative.
Sure.
So it would catch up eventually. So, I'm not too worried. But yes, if the markets today are at 34, if the markets were at 38,000 and the P would be 30 plus, then I would be really worried and I would do profit booking for my investors.
Okay. Now we've got a few questions and we'll ask the question from Melvin Matteo as well as Advait Vaidya in a bit. I think it's about the bond funds and maybe even the PSU Bank ETF. But first, finishing off the topic,
yes.
Gajendra, that we have at hand. So since you are recommending that people shouldn't necessarily look at the Nifty P multiples to base their investment decisions right now,
yes,
what should people do? Should people invest in balanced funds? We're getting a lot of noise about hybrid funds. We're getting a lot of noise about not looking at micro cap and small cap funds currently. What are you telling your clients to do?
Yes, absolutely. Even we as advisors are shying away from mid cap, small cap and micro cap category. We say, look, if you are here in the market to make 12 to 14% return, that can easily be offered by, let's say, a mix of hybrid funds and large cap equity funds. Then why take that unnecessary risk, and create volatility in your portfolio? So we are recommending a lot of balanced funds and large cap or multi cap focused diversified equity funds.
Okay. So let's talk about some of the recommendations before we move on to the questions that we have, Gajendra. From a balanced fund perspective, you are recommending a Reliance regular savings fund. Why this one?
So Reliance regular savings fund is a conservative balance fund, which means in the equity portion of the portfolio, they are more focused on large cap space, which in the recent past we've seen has kind of underperformed compared to the mid cap and small cap category. So we see a lower risk reward ratio, here, in the sense risk is lower, reward can be pretty higher.
Okay, for somebody who's got another balanced fund that does whichever it may be.
Correct.
Is there a need to shift to a Reliance fund? Is it that good, or people having investments in balanced funds can stay put in the fund that they have?
So if investors have been there for some time, then I would.
Switch is not necessary.
Is not necessary. Yes.
Okay, fair call.
Yes.
What about a large cap and a mid cap fund category? You are, I think, recommending a Mire India Opportunities Fund.
Yes.
Again, why this one?
So it's been my personal favorite in the sense I myself have been an investor for the last 7-8 years.
Okay, interesting.
And I've seen very consistent returns over the period. The fund manager sticks to the label, of 70-80% of the large cap portfolio and 20-30% of mid cap opportunities. Purely, it's a long-term fund, and one can reasonably expect 15 to 18% even over the next 5-6 years going forward.
Okay.
Yes.
And in this multi-cap fund, there are a bunch of options available. You are recommending a Parag Parikh Financial Advisory Services, but they invest in a clutch of overseas companies as well.
Right.
You are not recommending a pure play India dedicated multi-cap fund.
So again, Parag Parikh, what we have found is we have interacted with the fund managers and we have found that comfort, that they are purely bottom-up stock approaching, and even in the US companies where they are putting money, which is actually global stock kind of thing. So that 30% of the portfolio de-risk your entire thing. If for some Indian markets were to go down, this would serve as a good buffer. And if you see the track record, it has been a stellar track record so far for the last 3-4 years.
Well, yeah, that it has been. I think PPFS has done rather well. Couple of questions that we have, Gajendra. One of them is from Melvin. He's asking about whether, if the bond yields were to move up higher, is there merit in looking at some of the dedicated bond funds or debt schemes within mutual funds? What are you telling your key clients to do on this?
So normally we tell Neeraj that if you are a very savvy investor and you can timing bond yields is very difficult.
Very
thing
difficult.
Actually.
Right.
Even most fund managers are not able to do it most of the time. So we would rather say if you have a 3 to 5 year kind of horizon, you can actually safely go to a dynamic bond fund, where the fund managers has the choice to ride the yield curve. So rather than going for a long only GSEC fund or a pure income fund, go with a balance.
What would be the difference between these schemes?
So in a pure bond fund or an income fund, you are always long on the yield actually. You are having a high modified duration. So when the yields go up significantly, you have a significant downside. But when you go in a dynamic bond fund managers, depending on their assessment of the yield, they can temper their GSEC positions actually, and could come down to very low GSEC position or very high depending on what they see.
What would they replace this GSEC positions with?
So they replace with the short-term papers actually.
Okay.
So they overnight they can cut the yield risk which is there in the portfolio.
Okay. So a dynamic bond fund.
Yes.
In which case a dynamic bond fund would be a great option in almost all times, except for when yields are very low and they are expected to rise higher.
Absolutely, very true. So when you don't know which way the yields would go up, then dynamic bond funds play a better role. But if you know that the yields are all-time low and it can only go up, then it's better to go with a shorter-term fund or ultra-short-term fund, because then the risk is much lower in that case.
Okay, fair call. We've come to the end of this topic of discussion, but for the next few weeks, we're going to ask our advisors for one question, and that's with regards to ELSS. A lot of people have been sending in queries and asking about how would they invest, or whether they should invest in ELSS to save tax under 80cc. My question to you is, should people use that as an instrument, or should people use a pure play equity fund without going for ELSS and save tax by other routes?
Neeraj, if somebody is wanting to have a guaranteed return, in a portfolio, then PPF is the best option, we always say. But because you are anyway investing for longer term, like 15 years in PPF, why don't you use ELSS? We always advocate equities for long term. And if you see, even the worst of equity funds have smartly beaten the PPF over a longer term time horizon. So some of the ELSS funds in the last 18-20 years have given 100 times returns. Your 1 lakh has become 1 crore the first installment itself, which could have never been possible in a PPF. So I say, ELSS is a given thing. You should, 1.5 lakh, you should straight away put in ELSS.
Okay.
Whether you're a conservative investor or an aggressive investor, because you have anyway you are giving 15 years time, you will never be disappointed by the returns.
So what's the best ELSS option that you would be recommending to your clients currently?
So again, most ELSS we have seen have delivered similar kind of performances. The ones which have a longer term track record, ICICI Long Term Equity Fund, Reliance Tax Saver Fund, and DSP BlackRock Tax Saver Fund. One of these three funds, they can just keep on building positions there.
Okay, Gajendra. Just one final question. Somebody's asked about whether it's a good time to start into a Nifty PSU ETF. I'm not asking you for a recommendation there. I'm more asking you if you have started recommending such schemes to your investors, or have fund managers told you that this might be a nice thing to look into?
See, normally we tend to shy away from sector-based, or a theme-based, products, because you never know when the tide turns the other way around.
Sure.
And if you're not smart or tracking very well enough, you may be caught on the wrong foot, So we always try to go with a pure diversified equity fund. Let the fund manager take the call. I mean, in your show, you just mentioned, you're having a discussion pharma fund. So if I start taking sectoral calls myself, I may have a right entry, but I may not know what is the right exit.
True.
So I think that's best left to the fund manager. We as advisors, I think, are more suitable for asset allocation depending on clients' goals.
And which is why I was asking you that
we generally,
are fund managers telling you to start telling clients to invest into PSU ETFs?
So fund managers will definitely, over some period of time, they keep telling. But, the moment you start bringing these niche things into the portfolio, it becomes too much actually,
Okay, so do your study as opposed to really basing this on an advice of anybody.
Absolutely.
Okay. Gajendra, thank you so much for taking the time out and joining us on the Mutual Fund Show this week. And viewers, thanks for tuning in as well. You got a few recommendations. One that you didn't get and which Gajendra spoke about was an ELSS scheme. Choose from a variety of the ones available. Almost all of them have done well. A couple of examples that he chose were the DSP BlackRock Tax Saver Fund, or the ICICI Prudential Long-Term Equity Fund as well. But thanks for tuning in to the Mutual Fund Show this week.
Are we live? Welcome to programming that's insightful, authoritative, and at your fingertips.
Bringing news alive. So immersive, so new, and so addictive. You will want it no other way.